Right now, as you're reading this on January 8th, 2026, silver is trading around $60 per troy ounce in London. That's approximately $81 per ounce, up 180% from just $28.92 a year ago. But here's what your banking app won't tell you. That price is fiction. Let me explain something that's happening right now, something the LBMA desperately hopes you won't notice. While markets celebrated New Year's Day, China activated export restrictions that just severed the lifeline of the Western silver market. Starting January 1st, 2026, only 44 government-approved Chinese companies can export silver, and they must have annual capacity exceeding 80 tons and maintain $30 million credit lines. Think about what that means. China controls 60–70% of the world's refined silver supply. One stroke of a regulatory pen, and suddenly the spigot that feeds London, New York, and every Western manufacturer just got turned down to a trickle. Now look at London's vaults. As of November 2025, LBMA vaults held 2,787 tons of silver. That's about 874 million ounces. Sounds like a lot, right? Except roughly 25,000 tons of that is locked up in ETFs. Strip away those ETF holdings, and the theoretical free float is not much more than 1,000 tons. Just 32 million ounces of silver actually available for trading. Let me put that in perspective. Global silver demand in 2025 reached 1.24 billion ounces, while supply was only 1.01 billion ounces, the fifth consecutive year of deficit. London's free silver could satisfy global demand for roughly 9 days. 9 days. And it gets worse. In October 2025 alone, London vaults received 53.88 million ounces of emergency imports from New York, Shanghai, and international sources just to prevent a delivery crisis. That wasn't normal trade. That was emergency resuscitation. The patient is dying, and China just unplugged the life support. Here's the question nobody at the LBMA wants to answer. What happens when the physical metal stops arriving from China, but the paper contracts keep demanding delivery? 1 week ago today, something unprecedented happened. Chinese buyers approached Canadian mining company Kuya Silver, offering $8 or $10 above spot price for immediate physical delivery. Not tomorrow, not next week, now. These weren't retail investors panic buying coins. These were major Chinese manufacturers and trading firms, the kind of organizations that move metal by the ton, offering premiums that would have been unthinkable 6 months ago. Why the desperation? Because they can see what's coming. China exported 4,600 tons of silver in the first 11 months of 2025. That flow just got choked down to a fraction. But here's the part that should terrify every Western manufacturer. China accounts for 15% of global silver production but absorbs over 50% of industrial demand. Think about that arithmetic. China produces some silver but consumes vastly more. They've been a net importer when you count ore and concentrates. And now, they're restricting exports of refined metal? They're not cutting off supply to hurt the West. They're securing supply because their own industries are starving for it. In November 2025, Shanghai Futures Exchange inventories fell below 500 tons. China's renewable energy sector, particularly solar manufacturing, is consuming silver at a rate that's depleting their domestic stockpiles. The export restrictions aren't about trade war tactics. They're about survival of Chinese industry. But the Western press missed this completely. They saw the export restrictions and assumed it was geopolitical posturing. They didn't understand. China is hoarding because they're running low too. Now watch what happens in London. London silver holdings surged 12.8% year over year through 2025, which sounds healthy until you realize that's still down nearly 50% from the COVID-era peak of 35,667 tons in April 2020. And those October emergency imports? They came at the cost of massive price incentives and coordination across multiple geographic markets. Translation: London had to pay up, scramble, and beg to get that metal. It was expensive, it was complicated, and critically, it required Chinese cooperation. That cooperation just ended. On October 8, 2025, India placed an order for 1,000 tons of silver that instantly froze the London market. Silver lease rates skyrocketed from 0.25% to 200%. Swiss refiner Metalor, which operates in 17 countries, announced they wouldn't return to the market until January 2026. One order, 1,000 tons, and the entire London lending market seized up like an engine without oil. That was October. Now it's January. China's export wall is active. India is still hungry. reportedly requesting another 2,000 tons before year-end, and London has maybe 32 million ounces of tradable silver. Do the math. 9 days of global supply, China's gone, India's buying, and somewhere in a London trading room, a risk manager is staring at his delivery obligations and realizing the numbers don't add up anymore. Let me tell you about a system that's been running on trust and trickery for decades. When you buy silver in London, you typically buy unallocated silver. That means you own a claim on a pool of silver, not specific bars. It's like a bank account. You have a balance, but you don't have specific dollar bills with your name on them. This works beautifully until everyone wants their money at once. The LBMA has been running what amounts to fractional reserve banking for silver. They trade far more silver on paper than exists in physical form. The leverage ratios are opaque, but industry insiders whisper about 100.1 or higher. For every actual ounce in the vault, there are 100 claims against it. In normal times, this doesn't matter. Most traders don't take delivery. They roll their contracts forward, cash settle, or offset. The system relies on statistical likelihood, the assumption that not everyone will demand physical delivery simultaneously. But these aren't normal times. During October's crisis, London ETF holders liquidated 19.9 million ounces, while total global ETF liquidation was only 10.9 million ounces. London was hemorrhaging silver faster than the rest of the world combined. Why? Because sophisticated investors were converting paper positions to allocated physical positions before liquidity disappeared entirely. They weren't selling silver. They were running from the system. Here's what keeps me up at night. According to market analysis, this unallocated structure creates multiple claims against single physical inventories. When I say multiple claims, I mean different investors who think they own the same bar of silver. Their accounts say they own it, but only one person can actually take delivery. It's musical chairs, and the music is about to stop. Right now, industrial users are waking up to the reality. Tesla is circulating internal memos authorizing purchasing managers to pay above spot price for immediate physical delivery. Samsung secured 6 months of silver supply in advance, switching from 2 weeks inventory to 26 weeks. That's not normal procurement. That's panic hoarding. These companies have analysts who model supply chains for a living. They've looked at China's export restrictions. They've looked at LBMA vault data. They've looked at the deficit between supply and demand. And they've reached a simple conclusion. There won't be enough silver for everyone who needs it. So they're securing their supply now at any price, while they still can. But here's where it gets truly dangerous. Every ounce that Samsung takes out of the London system is one less ounce available for someone else's delivery. Every Tesla purchase shrinks the free float further, and each removal makes the system more fragile. Current physical silver premiums in the UK are running 3.96 above the weekly average, a 7.46% jump in just 7 days. The paper price says $60. But try to buy physical silver for $60. You'll pay $64, $68, maybe $72 depending on the product and dealer. The market is fragmenting before our eyes. There's the paper price in London, the official LBMA fix. Then there's the physical price in retail markets, what you actually pay for a coin or bar, and those prices are diverging rapidly. When the spread gets wide enough, something breaks. Force majeure. Keep that term in mind. It's what banks declare when they're defaulting but want to blame external circumstances. It means superior force, unforeseeable events that prevent contract fulfillment. It's the legal escape hatch that lets them say, sorry, we can't deliver your silver without calling it a default. And it's coming. In October, major dealers were already invoking force majeure. Metalor announced they wouldn't return to the market until 2026. That was before China's export restrictions took effect, before the free float dropped to critical levels, before the real crisis hit. Now imagine you're a bullion bank in London. You sold silver futures contracts at $45 per ounce 6 months ago. The buyer just demanded physical delivery. The paper price is $60, but to actually get physical metal to deliver, you'd need to pay $68.72 in the retail market or offer a massive premiums to attract metal from Shanghai or Dubai. You're losing 20-25 per ounce on every delivery. Your balance sheet is bleeding, your traders are panicking, your risk committee is in emergency session. What do? You declare force majeure. You send letters to clients. Due to unprecedented supply chain disruptions stemming from Chinese export restrictions, we cannot deliver physical silver. We will settle your contract in cash at $60. But your client doesn't want $60. They want the silver that's now trading at $72 physical. They wanted metal for their manufacturing process. They hedged their supply chain risk. And now you're telling them, sorry, have some paper instead. That's when the lawsuits begin. That's when the Financial Conduct Authority starts asking questions. That's when Bloomberg runs the headline, LBMA silver market faces delivery crisis. And critically, that's when the entire illusion collapses. For 40 years, the paper market in London and New York has suppressed silver prices through leverage and derivatives. They could create infinite paper silver. They could flood the market with futures contracts. They could keep the price down because physical demand never overwhelmed the system. But 5 consecutive years of deficit have eroded inventories. China's export restrictions just severed the primary supply line. Industrial demand continues growing. Industrial fabrication hit a record 680.5 million ounces in 2024, up 4% year over year, driven by solar panels, electric vehicles, and electronics that literally cannot be manufactured without silver. The mathematics are brutal. Demand exceeds supply. Inventories are depleting. The largest supplier just restricted exports, and the paper market in London is sitting on massive short positions with no way to source physical metal for delivery. Silver closed 2025 as the best-performing asset after a historic 26% surge in December. But analysts warn this isn't like 1980 or 2011. Those were speculative blow-offs that collapsed. This time, the fundamentals are different because physical tightness is real. Here's what I believe happens next. The paper price and physical price will continue diverging. We're already seeing 15 to 20% spreads between LBMA spot and physical retail. That spread will widen to 30%, then 50%. At some point, the paper market becomes irrelevant, a price that exists only on computer screens, while real transactions happen at completely different levels. Some dealers will declare force majeure. Others will impose delivery delays. In October, banks were already extending delivery times from 2 days to 2 weeks. Eventually, one major institution will fail to deliver. That will trigger margin calls across the system. Other institutions will scramble to cover, and the cascade begins. But here's what this really means for you. If you're holding physical silver right now, coins, bars, anything you can touch, you're holding one of the most strategically critical materials in the global economy. You're holding the metal that every solar panel needs, that every smartphone needs, that every electric vehicle needs. You're holding an industrial resource that's becoming scarce while demand accelerates. For decades, paper markets transferred wealth from physical holders to financial institutions through price suppression. They kept the price artificially low while quietly accumulating. But physics always wins eventually. You cannot deliver what does not exist. You cannot manufacture products without actual raw materials. The LBMA won't announce their crisis until they have no other choice. They'll delay, obfuscate, and deploy every accounting trick to maintain the illusion of normalcy. But the vault data is public. The free float is measurable. The mathematics are undeniable. China knows. That's why they restricted exports. India knows. That's why they're placing 1,000-ton orders. Samsung knows. Tesla knows. The smart money already understands what's happening. The only question is, do you? Silver has surged approximately 180% in just 1 year. Most people see that chart and think they missed the opportunity, but they're reading it backwards. That 180% surge wasn't the repricing. It was the warning shot. It was the market's first acknowledgement that something fundamental has broken in the supply-demand balance. The real repricing, when the paper market admits it cannot deliver, when force majeure becomes widespread, when the price fragments into paper fantasy and physical reality, that hasn't happened yet. But it's coming. The countdown started January 1st when China activated their export restrictions. The vaults in London are depleting. The industrial users are hoarding, and somewhere in the LBMA clearing system, there are delivery obligations that cannot be fulfilled with metal that does not exist. Stay informed, watch the vault data, monitor the premiums, and understand that in a world where paper claims vastly exceed physical reality, the only silver that matters is the silver you can actually hold.